Welcome everyone to today's program. I'm Robert Kurtz, moderator for the webinar. The program will begin with a roundtable discussion between our panelists, and then we will have a question and answer session following completion of the roundtable. You can submit any questions you have throughout the webinar by typing them into your control panel in the space labeled Enter a Question for Staff and clicking Send. Our panelists will attempt to answer as many questions as they can during the Q&A portion of the program. It is now my pleasure to introduce today's panelists. We have Blayne Rush, President of Ambulatory Alliances. He is an SEC-registered and FINRA-licensed investment banker. He specializes in ASC brokerage, ASC turnarounds, and increasing ASC valuations through physician recruitment and syndications, and access to the capital markets and capital structuring consulting for surgery, urgent care centers, and radiation oncology centers. We also have Bernstein, Managing Director for Sinaiko Healthcare Consulting. Kurtz specializes in providing valuation, transaction advisory, strategic and operational consulting services to clients. He has extensive experience working closely with hospital systems, physician groups, ASCs, and other healthcare providers. We will now begin the roundtable. I'm going to direct the first question for today's program to Blayne. Blayne, could you speak to what is the difference between market value and fair market value?
Yeah, thanks, Rob. I appreciate you hosting this segment and for Kurtz joining us and all the viewers and listeners out there. Appreciate you guys giving us your time. But to answer that question, we must look at the definitions first. The Internal Revenue Services define fair market value as the amount at which property would change hands between a willing seller and a willing buyer when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, and when both have reasonable knowledge of the relevant facts. The Social Security Act defines fair market value for purposes of Stark regulations as the value in which an arm's length transaction consistent with general market value. So the fair market value means a value in arm's length transaction consistent with general market value. General market value means the price that an asset would bring as a result of a bona fide bargaining between well-informed buyers and sellers. So the fair market value world is not the real world. It's hypothetical. It's highly regulated. It assumes that willing buyers and sellers exist, that the power among them is proportionally distributed, and they're under no compulsions. It defines the participants as very specific and predictable actors. It assumes that the players are rational and consistent in their dealing, including the appraisers who theoretically use fair judgment when they apply certain methods for the valuation. In other words, fair market value is a value world of hypothetical willing buyers and sellers in a hypothetical business transfer. The fair market value business valuation is based on assumptions that a sale has taken place between a hypothetical, predictably rational buyer and seller. In fact, the real world is populated by real people whose actions are very unpredictable, as we all know, not subject to consistent definitions, and who engage in actual transactions with unpredictable outcomes. So to make the contrast against the hypothetical world of fair market value describes the value of a business interest in the marketplace is the real-world value of your surgery center. Market value, simply put, is the highest purchase price available and the best terms available for this particular surgery center in the open and competitive marketplace. And it adapts from a concept from commercial real estate appraisal. The market value focuses on determining the highest and best value of your surgery center business.
Excellent. Kurtz, did you want to add anything to that?
Sure. From the valuation perspective, the first thing we try to do is define who the hypothetical buyers are. So yes, they're hypothetical, but we also have to connect that with some sense of reality and determine who those hypothetical buyers are. So if you're talking about a surgery center and you're talking about a non-controlling interest in a surgery center in which a management company already has an ownership, chances are that under the current buy-sell agreements or operating agreements, you probably can't even sell that interest, minority interest, to anyone besides a physician within the market. So then, you're going to have to define how many physicians are actually in that market that would be willing to pay that interest. Because a number of the physicians in the market may already have interest in ASCs. They may be locked up in non-competes, for example, and may create lack of marketability discounts in your analysis. And we'll talk about that more as we progress through this presentation. From the controlling interest perspective, once again, it depends on who the owners are, but it might be the local health systems, it might be the larger management companies. And then, you've got very interesting factors in the healthcare market in that your buyers may be able to earn a different rate to provide the same service. So for your orthopedic procedures, your health system locally may have a different negotiated rate with your managed care payers than your local surgery center if your surgery center has been owned strictly by physicians. So, in the fair market value standards, there should be some kind of tie-in there with the market value standard that Blayne talks about from the investment banking side, because in reality, there's a market rate of return that buyers are expecting. Let's say it's 5 years maybe return on cash flow. Well, then all your buyers are different. And we talk about investment value, which we didn't cover here, but investment value from the valuation perspective is the value to a specific buyer. And we can't consider that under the fair market value standard because we're required to follow the fair market value standard under the anti-kickback law. And as I'm sure a lot of people listening to this, looking at the participants list, know that ambulatory surgery is not a designated health service under Stark. So you don't fall under Stark so much as you fall under anti-kickback, because the doctors that own ultimately refer cases to the surgery center. So you have to follow the fair market value standard under anti-kickback. But at the same time, you need to define who those buyers are in the market and what their rates of returns are. What the different buyers may have out there in the market and what they might all consider in the transaction. And there needs to be some tie-in between that fair market value and market value. Fair market value, while hypothetical, still needs to have some sense of reality in it and what's going on in the market.
Excellent. Thank you. Blayne, any final thoughts?
No, I think he covered it well. Thanks.
Excellent. Kurtz, I'm going to stick with you for our next question. I'm going to have you lead the discussion on how do buyers determine their offering price when approaching ASC acquisitions?
And that'll vary. As I just mentioned, buyers, no matter who they are, so long as there's physician owners and they're purchasing the interest from a physician owner, or the physician owners remain within the ASC, are required to follow the fair market value standard under anti-kickback. Yeah, you can't pay in excess of fair market value because that excess may be considered payment for referral. So you have to pay fair market value, and then the question is, how do buyers actually determine what fair market value is? And that really varies. We have a number of clients that are pretty sophisticated and feel that they know what fair market value is, and they may go out and do an internal calculation of what they believe to be fair market value and offer that price without ever getting a valuation opinion. We've got other clients that go through the same process, but at the end of the day want that fair market value opinion to support that purchase price. Generally, they've worked with a number of evaluators and know where an opinion from someone like me would come out. So they're pretty comfortable going out and making offers and starting the process before going through the valuation process, which can obviously make sense because the valuation process can be lengthy. And then there's other buyers that require evaluation before and say, we want you to tell us what fair market value is from an independent perspective before we ever make an offer to purchase the acquisition. So there's at the end of the day, no matter whether you determine it internally, and then get evaluation, or get an evaluation the upfront, the price is determined based on the expected market rate of return and the expected cash flow of the center. And that cash flow can vary. We look at historical cash flow, which is very interesting, but it's really projected cash flow, which is probably most important in determining fair market value. and what can be done with the center. You know, is the center already at capacity? Is there ability to grow? What are the managed care contracts like? Is there ability to improve those managed care contracts? What type of physicians are currently operating within the center? What does their specialties look like? We're going through a significant phase of employing physicians. You know, what are the chances those types of physicians are going to become employees? Is there ownership interest already by the hospital? You know, we're seeing a lot more development companies joint venturing with health systems now, because if the hospital is going to go and employ the physicians, the management companies want to make sure those physicians continue to do cases within the joint venture surgery center. So obviously important to get that involved. And then, you know, as I mentioned, the rates return. Some buyers may look at it from their internal rate of return. From a fair market value perspective, it generally has to be a market rate of return. And then, like I said, it really, you know, there has to be some tie-in between that market value and fair market value, because there's different rates of return in the market. You know, some people require 5 years, some people require 7 years, and the question is, what is the best to use in that market? Is it the average? There's really, just real quickly touching on valuation theory, I mean, there's really nothing written out there from the fair market value perspective that says, you know, you use the 5%, use the 7%, use the middle, you know, the 6%, the average of the industry. I should be saying 5 years, 6 years, 7 years, whatever. But I think ultimately you get the point, is that there's nothing written out there that says what to use. There is stuff on the real estate side and the equipment side that talks about highest and best use. So maybe if you find out that a good number of buyers require a 5-year return, then 5-year return is probably what you need to use in determining fair market value for the surgery center, even though other buyers out there require a 7-year return. So that, I mean, in summary, you know, there's a number of different ways that buyers can determine the price, and evaluation should kind of go hand in hand with what's reality for those buyers. Do you have anything, Blayne?
Yeah, whenever I'm answering this question, I'm looking at it from the standpoint of, or mainly from the standpoint of a physician-owned surgery center that has a buyer that is either a private equity group, a hospital health system, or a strategic corporate partner, if you will. And whenever those guys go in and look at a center, they may look at, hey, they look at profits, and then what is the risk to those profits? And whenever the industry looks at it, they put it in different tiers a lot of times, and a lot of that, that's in the criteria for those tiers, Curtis just went over, but real quickly, highly profitable, limited reimbursement risk, relatively low out-of-network percentage of business, because that goes to the stability of the reimbursement rates, you know, not dependent on too few physicians, limited non-compete, certificate of need protection if that exists, and the ability to grow the center. But more on a scientific basis, according to one of the most popular valuation surveys out there, they use, a lot of the buyers use a discount cash flow analysis, a standard of EBITDA, a risk-adjusted multiple of EBITDA, and a third-party market valuation opinion, all that Curtis just said. But third-party valuation is dependent on the cash flow method, so they use the discount cash flow method. And we'll come back to that in a little bit when we answer some of these other questions.
Excellent. Thank you. Curtis, I'm going to ask you to start a discussion on this next question as well. What can an ASC do to increase its value?
Yeah, well, kind of adding to what Blayne just said, you know, a lot of the buyers look at multiples of EBITDA, and they may be trailing 12-month EBITDA, they may be projected EBITDA, and I think one of the best things an ASC can do to increase value is prove that projected EBITDA is going to be significantly different than trailing EBITDA, and why it's going to be significantly different. I know in Blayne's area, he'll talk about a little later syndicating the surgery center to additional doctors and getting more doctors involved, locking them into non-competes. Well, that's all stuff that you can do to increase the ASC value from what you've had historically. As Blayne just said, the buyer is going to look at profits and, you know, what are the risk associated with me keeping those profits into the future. And I think to add to that is what do we do to increase those profits in the future as well. You know, the management companies and the private equity groups and stuff, they have investors, and when they deal with their investors are going to look at same-store growth. And while I know these aren't like stores like your retail stores, the term stays the same. And what they want to see is, has my bottom line for this surgery center increased year over year? And that's going to increase in a number of ways. One is patient volume. One is your net revenue per case. One is decreased cost and efficiencies gained. And the more that your surgery center has the ability to achieve those different areas, obviously the higher it's going to have in value to an owner. So working with someone like Blayne, obviously, to figure out how you do that, I guess is critical from the perspective of making sure you get the most value for your ASC on a sale.
Blayne, do you have anything to add to that?
Yeah, I mean, just to add to what Kurtz was saying, the ASC values are based on profitability and future risk to that profitability. You know, we said that. So pretty much anything that you can do to increase its profits and reduce risk to those profits will increase the value. So like he was referring, lower the price on supplies and implants. A lot of people don't look at that, but that's huge. And some of the largest, and we'll talk more about that, is adding cases, both from the doctors that are there now and physicians that you can recruit. And whenever the buyers go look at this, they put more emphasis on the cases from the physicians that are invested in the surgery center, because they see the risk of some of those cases walking out the door if the physicians aren't invested there. There's no incentive for those guys to continue to have those cases stay there. They'll also look at the age of some of the physicians. So if you have some older physicians that are nearing retirement, they'll look at that. So if you create some strategy, say it's a group of physicians, and they have some physicians in that group that are retiring, if you encourage them to bring on younger physicians that would keep those cases in that group, that's another way to drive up the value.
Thank you, Blayne. And our next question, you've touched on this a bit, but certainly want you to elaborate and also introduce a new topic here. What can an ASC do to increase the number of offers it receives from buyers? And again, a little more about increasing the value of those offers. Blayne, can you start?
Thanks, Ron. Whenever a seller of a surgery center goes into this process, they need to be prepared and understand what they want out of this. So what are their goals? And they also need to know the goals of the potential buyers, because buyers that want what you have will make the highest offers. So you need to do homework and prepare your center for sale. Preparation and organization of your center will show the buyers that you're educated and informed. You'll be in a better position to be able to convey the historical and the future story of the center, which they want to know. Not doing that will increase the likelihood that the entire story and potential of the center will not be known to the buyers, because buyers are going to come in and have conversations and look at your center and whatnot, but they'll a lot of times miss pieces that are very important and say, well, I'm not interested in that center. But if they had the right information, they could be interested in that center. The The valuation community has defined hypothetical willing buyer as any likely buyer, as Kurtz pointed out earlier. So it's to your benefit to hunt down those any likely buyers. So you need to go into the marketplace and be proactive versus reactive, because a lot of these surgery center companies and buyers have their development staff that'll come to you and say, hey, are you interested in selling your center? Well, even if that happens, which it's good for you, you need to consider multiple other potential buyers as well, because you're going to turn around and leverage them against each other and negotiate them against each other. We'll talk more about that in a little bit, but that will help create competition for your center, help get more offers for your center, and help drive up the price that you ultimately give for your center.
Excellent. Thank you, Curtis. Would you like to add to that?
Yeah, Blayne, I would like to just say that one thing the group needs to understand is that the buyers are restricted by the fair market value standard under anti-kickback. But that doesn't mean that a buyer has to offer fair market value. With regard to surgery centers, you're dealing with surgeons who refer to the surgery center, and those, and ultimately, what your buyers are trying to make sure is that they're not paying above fair market value, so that any of the compensation or remuneration above fair market value would be considered a kickback for referrals and using the surgery center. So if you go out, to your local health system and you look to sell your surgery center, and they come back with an offer, even if they have a separate valuation done from a firm like mine and we're engaged by the health system, that doesn't guarantee that that offer that you're getting is going to be the maximum number that I may come up with in my valuation. It could be lower. So going out there and getting different offers obviously makes sense to make sure that you're getting the highest value. And then, the buyers may not always come back with their highest offer. So going back to them and the buyers should only go up to the point where they feel comfortable that they're still paying fair market value for that surgery center and that interest in that surgery center. I mean, I guess if you're talking from the seller's perspective here, the seller needs to feel comfortable that the buyer is going to go up to a point where they feel that they've hit the maximum they can support and still be comfortable that they're not paying more than fair market value under anti-kickback or under the private inurement rules if it's a health system that's a not-for-profit.
Thank you. Next question, I'm going to have Blayne start the discussion on this. Blayne, how can market value influence fair market value?
Yeah, it's a good tie-in from what Curtis just said, because fair market value is typically presented as a value range, or in other words, a range concept, really, where you see a definitive singular number presented as the fair market value of an ambulatory surgery center. So going out there, like Curtis was referring to, and presenting your center to multiple buyers, multiple buyer types at the same point in time, and then turn around and negotiating with the ones that have an interest in your surgery center and coming up with potential or offers, bona fide offers from those guys. And when I mean bona fide offers, talking about written offers that and they have a strong interest in purchasing your surgery center at that offer price, then that will allow you to push the fair market value or the purchase price, if you will, to the top of the fair market value range, because a lot of times, again, these buyers will come in and evaluate your center, make an offer of your center, and tell you that it's fair market value, or they'll get a fair market valuation from a valuation professional. And sometimes that valuation professional isn't a ASC expert, and some of their data is years old. I've seen fair market valuation reports that had comps that were years old. And so this process will help align the fair market valuation professional to what the market looks like. So if you take those bona fide offers that you get, present them to the fair market valuation expert, that will allow them to be educated and what the real market looks like at that point in time.
Kurtz, do you have anything to add?
Yeah, and I think this may be jumping ahead a couple of questions, and I'd like to start off by saying I'm not an attorney, so this is just my understanding, and I know there's attorneys listening. They can feel free to write in to clarify if I get anything wrong. But ultimately, the anti-kickback statute, let me draw a little bit of an example here. But if we have a surgery center, and let's say it's fully physician-owned, and the physicians are looking to sell a controlling interest to a health system or a management company. Under the anti-kickback statute, if the health system comes in and says, I'm willing to pay $1 million for your surgery center, and that's fair market value, well, the prosecutor who would come in and say, no, you paid more than fair market value, would have to prove that the health system had intended to pay above fair market value to induce referrals, in essence, that they were actually paying for a kickback, before the health system would ever be found, in default for actually paying a kickback. So it was their intent to, they'd have to prove it was actually their intent to pay a kickback. And so from the perspective of, if you have a number of physicians owning a surgery center, and you have a number of health systems and management companies out there competing for their business, and you have the market value in essence because you're bidding it up, and they go to a point where they're comfortable that they can still support it from a fair market value perspective, whether that's done internally or is done through a fair market value done by an independent appraiser such as myself. The doctors probably don't have so much to worry about because they're relying on the health system to tell the doctors that what they're offering is fair market value. And even if it was not fair market value, they'd have to prove there was intent. So if you have a bid process and you have a number of bids and they're all around the same amount, I think that even helps support you from a regulatory perspective and say that, we had 5 different offers, they were all within this range, and therefore, even the government may say, well, that was above fair market value. Well, you've got a lot of examples, and even if it was above quote-unquote fair market value from the independent valuation perspective, you probably have less issues from a regulatory perspective because then you'd have to say that everybody had intended on paying for referrals and they were all kickbacks, which I think would be a hard argument to make, but that's really more questions for an attorney. So I think ultimately the market value and fair market value can go hand in hand. I don't even know that physicians really need to get a fair market value opinion because they can rely on the health systems to do that who are buying in and actually paying fair market value. Because really the concern is the health systems or the management companies paying those kickbacks.
Thank you, and I think you've transitioned
Let
well
me
to
add
this next
some,
question. Oh, go ahead, Blayne.
Rob, can I add? Yeah, because whenever I'm involved in these transactions, I rarely see a seller that gets and pays for the fair market valuation. It's almost always done by the buyer. And I guess Kurtz could speak more to that, see how many people he's engaged by, but that's my experience. And I know that Kurtz touched on that, but my experience is that the buyers get those taken care of.
It's mostly the buyers. On occasion, it's the seller who may just say, I want to know what it's worth before I go out to the market. But it's rare, and in my experience, when I get a call from a seller who says, hey, I want to know what this is worth before I go to the market, I'll generally refer them to someone like you, Blayne, and just say, hey, I think, since you're really looking for an exit strategy, I think you should have actually someone like you, Blayne, or other people out there that do your type of work to take a look at the surgery center and people on Blayne's side can do kind of a valuation, back in the napkin kind of valuation, and because they've had so much experience with this, they may have a sense of what it's worth without really giving them a full valuation opinion and having anyone spend all the money on the valuation opinion. They can say, well, this is what I think it's worth, this is what you can do to make it better, and then, we could probably get it up to this from the valuation perspective and work with the physicians and the surgery center to improve the value before really even doing a valuation report. because, from my perspective, once I do that valuation report, I say what's worth today, then, they go through that process of improving operations and efficiencies and syndicating new doctors and whatever else, then, I'm just going to have to do the work all over again. I mean, there's really no efficiencies there. The operations have changed so significantly. The financials have changed so significantly. We have to dig back in pretty deeply to understand exactly what's going on. And, you're almost doing twice the work and charging the client twice as much, and it's no benefit to our client to really do that. I'd rather do the valuation at the end to help with the transaction.
Thank you. Blayne, any final thoughts before I move on to the next question?
No, I mean, I do have one, and I think we'll speak more deeply about it. But the time that I would say that we would need a quote-unquote fair market, a third-party fair market valuation, is after we go through and do a physician syndication to project out the future revenue, because a lot of times some of the buyers will look at historical earnings versus our future earnings, and that will help justify all of the process that we just did in syndicating physicians, letting them season a little bit, 3 or 4 months of their case volume and whatnot, and then projecting that out. I think that's a time that it would help the seller's purpose.
Thank you. Blayne, I'm going to stick with you. Again, a question I think we've already touched on a bit, but physicians are ready to sell their ASC, or at least an interest in it. How do you advise them properly using the market valuation, fair market valuation processes?
Yeah, like you said, I think we've covered that, but to summarize it, I would say, hey, go to market, get multiple bid and bid proposals, negotiate those to where everybody's comfortable, then turn around and get the fair market value taken care of afterwards. And again, unless you go in and you syndicate the center and you bring in new physicians and some of their revenue is newer, you can do the discount cash flow, which is going to project out that new revenue for the next 5 years with a growth rate and a discount rate in represented as today's dollars.
Excellent. Curtis, anything to add?
No, I don't think so. Good answer.
That's fine. The next question, Curtis, I'm going to stick with you. And again, I think this is what you've already touched on the 2 questions before. But ASC receives an offer above what is determined to be fair market value. Can it accept it?
Yeah, so kind of like I said, obviously I'm not an attorney on this, but from the perspective, it's really only covered by the anti-kickback, and I guess the question to this question really is, how does the ASC even know if it's above fair market value unless they deal with their own fair market value opinion, or they're working with an investment banker who says, wow, this is really high, I really like this offer, but I think it's probably higher than I would have ever expected it to be, and maybe not. The issue you deal with is, if you're going through that market value process and you get 2 offers at $1 million, you get 1 offer at $3 million, let's say, the issue that you deal with is that, ultimately your deal can blow up because, the government may come in and say, hey, you paid more than fair market value. It was a kickback, and the purpose of paying more than fair market value was so that these doctors would continue to refer to the surgery center and even possibly refer to your hospital into the future. So, that just causes contention between all the parties involved at the end of the day if you're involved in this major lawsuit around anti-kickback. So you probably don't want to, take that $3 million offer when everything's around $1 million. But, if you got $1 million, $1.1 million, and $1.2 million, I don't see why you couldn't take the $1.2 million. And you've got an investment banker with you or evaluator who's helping you analyze the different valuation reports from the buyers or whatever else, who says, it appears to be clean and fair market value or whatever else. I think ultimately you're going to be fine. So I guess the short answer to it is probably. I don't, if someone offered you an amount that it seemed reasonable, then he probably could accept it.
Blayne, do you have anything to add before I have you start the next question?
Yeah, I think we all recognize that that buyers are bound by the tenets of pay and fair market value. And I would be uncomfortable making a definitive statement that suggests that a seller can accept an offer above what is deemed fair market value. And so I'm making the assumption for a second that a fair market valuation has been done. And one thing that you can do in that situation, so say that you have some offers that are above that fair market valuation, is challenge that fair market valuation. Some of the appraisers or valuation experts out there don't have enough data because we're working on the private markets or in the private markets, if you will, and we don't publish that data of the transactions and the numbers, and that's probably why my phone rings a couple of times a month from some of the evaluation guys looking for that data, which I appreciate and understand. But you could probably hire someone that has experience or a lot of experience in the transactions and that is a fair market valuation expert in the surgery center space. Engage that person to evaluate that valuation and maybe challenge that. And, you might come up with a different valuation at the end of the day.
Thank you.
I have to agree with Blayne on the part where he said, if you have your own fair market value opinion and you determine that other offers are above that fair market value opinion, you probably should challenge the fair market value opinion and make sure it's acceptable. And, I definitely agree you shouldn't accept an offer more than fair market value. My point was really just more toward if you don't know what fair market value is and all the offers are pretty close, there's probably nothing that you're going to say, well, you accepted it and it's above fair market value. Well, you relied on the buyers, and if they were pretty close, then you're probably okay. But I definitely agree that if you have your own fair market value opinion, you know what fair market value is, you definitely should not be accepting offers above that. So.
Excellent. We'll move on to the next question. Blayne, I'm going to have you start the discussion on what an ASC can do to influence trailing EBITDA.
Thanks. So we understand, and according to the reference valuation survey, that EBITDA and discount cash flows are major methods of determining offer prices or valuations, if you will. And we need to understand what they measure and their function in order to understand how we can influence those values. And as we've spoke about, EBITDA is past performance. And physician owners, or even small business owners for that matter, are accustomed to thinking about revenues as minimizing taxable income, while investors are focused on revenue in terms of maximizing profits. So while minimizing taxes is a good strategy for tax time, it doesn't accurately represent the financial performance of your center. And your goal when you prepare to sell is to adjust the operations of your center in order to maximize earnings. And if you do this after the fact, what I mean by after the fact, so say you're trying to go back from today and look at all the things that you can adjust, in the past, so last year's earnings and year-to-date earnings. Well, you go in there and recast the financials, or some people call it normalizing the earnings. So these adjustments to the income statement balance sheets allow buyers to appreciate the maximum profitability of the center and the true value of the assets and liabilities. So keep in mind that physicians want to maximize value capture, and buyers will want to minimize it because they're looking to, a lot of times, buyers are looking to pay as least as possible. So they will scrutinize the add backs, but some of the things that you would look at: compensation for owners and employees. If you have key employees that you're paying way above market rate, or if your physicians are getting huge compensation, you would want to add some of that back. Perks, fringe benefits, your condo in Hawaii, your Learjet. I'm joking, obviously, but those types of things that some people put on the books: travel, entertainment, personal use of other assets, one-time items, lawsuits, bad debt expenses, a big donation that you made to the college that you went to, things like that. You would add that back, and it would give you a better EBITDA at the end.
Curtis?
Yeah, Blayne, from a valuation perspective, Blayne touched on this. We deal with normalizing entries all the time. And so normalizing entries come in two forms. One is the one-time or discretionary type of expenses. So as Blayne mentioned, like a donation, large donation, those are things that management can influence. And just to back up a little here, I'm really talking about when we're valuing a controlling interest, because there's difference from the valuation perspective between controlling and non-controlling. So when you're talking about a controlling sale, there are things that the previous owners may have done that a controlling shareholder can now control. In a sense, they have the ability to say, no, we're not doing that in the future, or yes, we are doing that. And for example, that might be donations or any of those other non-discretionary expenses. And then there's just the adjustments to normalize for changes in the operations over time, and that works both ways. Whether it's increasing EBITDA or decreasing EBITDA. If you had to add staff, and historically you haven't worked with that staff, and maybe the surgery center was out the administrator for 6 months and hired a new administrator, and you only have 3 months of administrator salary within the current period. We might make a normalizing adjustment to make sure that a full-year administrator is in there going forward, whereas the physician may have employed their wife, one of the main physicians may have employed their wife to do a lot of the administrative function for $150,000 a year. You might normalize that down to $45,000 a year if that's the going rate for the type of position that's necessary to perform those services. So we make those normalizing adjustments, and you got to look at the different areas. For example, you may want to look at revenue, and if you have a surgery center that is 100% owned by physicians and doesn't work with a professional management company, there might be money being left on the table where the controlling buyers can go in there and look at those reimbursement rates and go and try to negotiate better payer contracts. Not necessarily bringing their payer contract to the table, they'll be able to increase payer contracts. And I think that's important because, remember, we're stuck with the fair market value standard going all the way back to the beginning of this. We were talking about hypothetical, and I mentioned investment value, which is a specific buyer. But you can't look at what the specific buyer brings to the table. You have to look at the hypothetical and what all the buyers within the market or the majority of the buyers within the market can do with the operations of the center to help increase EBITDA. And Blayne mentioned implants. You may be able to control the use of various types of implants and bring that down. If you go to the major surgery center events, the big things everyone touts is our managed care contracting, access to our GPO, access to our quality data to be able to improve your quality and reduce your costs and all those things. So those are the things that controlling interest buyers bring to the table. And those are the things you need to look at when getting a valuation done to make sure that those are in line with what can be done with the center in the future if a potential buyer takes over a controlling interest.
Thank you, Curtis. Can you speak to this slide here about the adjusted revenue related to contract then?
Yeah, I mean, this is just an example of one way we look at, the different CPT codes that are being done by the center, looking at the reimbursement within the market for different surgery centers and adjusting up the reimbursement based on what's done historically, based on or to the amount that is consistent with what's going on in the market, where you may have a center that's getting $1,500 per orthopedic case, and 25th percentile reimbursement might be $2,500. Well, we can look out to the market and say, well, what are the reimbursement rates in the market? And if we brought in a qualified management company or a hospital to come and help us negotiate these rates, what could be achieved, and that could be done even without the purchase. I mean, you can pay a 5% management fee to these entities and hopefully drive up that revenue. So it's something to look at when doing evaluations.
Thank you. Blayne, do you have any final thoughts?
No, I think you covered it all. Appreciate it.
Excellent. Kurtz, I'm going to stick with you to start a discussion of our final question before we get into the Q&A. What can an ASC do to influence and increase the value of future cash flows?
Well, obviously there's the normalizing adjustments, which we talked about, and then there's just the ability to go out and find new doctors and new users based on capacity. And Rob, if you want to go to the next slide, we look at the cash flow of a center, so the sample center, and then if you added 200 orthopedic cases to the center, let's say that's 2 doctors or 1 doctor that can syndicate to 1 doctor, a lot of your costs are already fixed, right? So you already have all of your space. You might even have the orthopedic equipment already, for example, and you may need to add some nursing staff, and obviously you're going to have to buy supplies for the cases. But at the end of the day, that adds a significant level of cash flow to your bottom line just by syndicating out to different doctors. And from the stuff we've talked about, obviously you want to lock those doctors in financially from a non-compete perspective, make sure that those are there. From the investment banking perspective, which I think Blayne will talk a little bit about, you're going to want them to season, which means that the physicians have to be in there for a few months, and I think there's some legal requirements around that as well. Like I said, I'm not an attorney. But ultimately, just adding another doctor and some more cases adds significantly to that bottom line. And then, Rob, on the next slide, we show the multiples of those. So if you look at the historical EBITDA, and we took a 6 multiple on that, what your value would be. And now that you've locked in new doctors, you have higher cash flow, better probability of that cash flow because it was good orthopedic cases. You can probably get that multiple up even a little. So not only are you increasing EBITDA, but you're increasing your multiple from a fair market value perspective and raising the value both ways, which drives value.
Blayne?
Yeah. So, I mean, that's the example of the stories that everybody hears when they go to the conferences or whenever they speak to someone that spoke to someone that spoke to someone that talked about, hey, I just sold my center for some outrageous multiple of 12-month trailing EBITDA. So remember that EBITDA is past and discount cash flow is future in its present value. So this right here tells you how those guys got that outrageous multiple of EBITDA. So what they do is go out there, or what we help people do is go and recruit physicians that align with your surgery center. He's talking about orthopedics, so let's assume that you have a orthopedic group here that owns the majority of the surgery center. So we'll go out and add pain management, podiatry, whatever, and drive those cases up, let it season for a period of time, and then take it to market at that point, and you will realize the gain that, or a big piece of the gain that the strategic buyers want to see themselves. So they'll buy it and then turn around and do what he's just explained to you, and you'll only get a piece of it, versus you doing it before you go and sell. You'll get a multiple on that piece.
Excellent. Kurtz, any final thoughts on that before we move into the Q&A?
Nope, I think that was well said.
All right. Well, now we're going to begin the question and answer portion. We have a number of questions that we've received. Before I get into the Q&A, if we don't have an opportunity to address your question, or you have a question after the fact, or you have any feedback, or want to request a business-focused topic for a future webinar, you have Blayne's, Kurtz's, and my contact information on this final slide here. Definitely encourage you to contact any of us, again, with any feedback, follow-up questions, or again, any requests for future topics you would like to see covered in future webinars. First question, I guess, Kurtz, I'm going to have you initially speak to this. concerns about selling below fair market value. We certainly talked about potential concerns about selling above, paying above fair market value. What are their concerns relating to selling below?
I think that's probably a better question for an attorney, actually. But I mean, I really can't think of any. I mean, I've been doing this a while in the healthcare field, and obviously, sometimes there are concerns that someone may provide a service to a health system for access to maybe other patients. So they provide a service a little less so that they get certain, other patients, maybe managed care patients or whatever. But you generally don't see that very much within the surgical area. Obviously, the main concern is overpayment from a kickback perspective, overpayment from a not-for-profit and private enrollment, being that all the physicians and generally the health systems are for-profit. So you can't pay more from that perspective. I really can't think of any off the top of my head concerns with under fair market value.
Blayne, anything come to mind for you?
Yeah. Well, in the sense of whenever you syndicate to new physicians, people are worried about selling below fair market value to physicians that can turn around and bring patients to your or cases to your surgery center. So you want to be careful there where you don't sell it below fair market value to physicians that you're syndicating to.
Yeah, that's a good point. I was thinking more from a controlling perspective, but you're right. From the minority perspective, and anytime you're selling to doctors who refer, whether it's controlling or non-controlling interest, you want to make sure that they're not paying below fair market value, so that they get access to the profits of the center for less, and then they continue to earn distributions and achieve a significant rate of return on their investment. And while referring cases for that return.
Excellent. I think let's move on to the next question. We've got a few more minutes to tackle some of these. Curtis, again, I'm going to start with you on this one. If we want to sell our center and a buyer wants to buy, but the fair market value is too high for them to buy in, what can we do to lower the fair market value?
Yeah, and I think to Blayne's point, we generally see that with the physician buy-ins where there's concern that the physicians, where there's significant profitability, and the valuation comes out with, let's say, $50,000 a unit, and the surgery center down the street may be struggling and offering shares at $15,000 or $10,000, just so it's not confusing between 50 and 15. So they may be offering shares for $10,000 a unit down the street, but you have significant profit. And it's definitely a challenge that we've seen in the market. There's really, I think there's a few things you can probably do, which Blayne will talk to, as far as bringing down that value. But from the valuation perspective, make sure the valuator is accounting for the actual number of hypothetical buyers out there. A significant number of physicians within the market are tied up through non-competes within other surgery centers, and the operating agreement says that it has to be a doctor of the Class B shares, and that's what's being sold. Then there may be a push to increase the level of the discounted marketability. So that's definitely one way, and I know Blayne has some other ways. Blayne, you want to build this plan?
Whenever you look at the valuation, it's the number minus debt. So one way that investment bankers go about it is you pile debt onto the center. The existing physicians can pull some of that debt out, and that because the debt is on the center, it turns around and lowers the value of the center.
Okay, excellent. Let's move on to the next question. There's no final comments. Very good. If you're looking at buying an ASC and has a current management agreement, how are you valuing the management agreement? Curtis, maybe start with you on this.
Sure, Rob. I guess not 100% sure on exactly the question as far as managing or valuing the management agreement. If there's two questions that could possibly lead to. One is if you have a company that manages an ASC and you're looking to buy out that management agreement. So you're looking to, if you have a Symbion or an AmSurg or an FCA managing the center and you want to buy out their future cash flows, it would be similar to valuing an ASC, where you'd look at, what those companies would be losing in the future through their management agreement to get them out of there. The other part of valuing a management agreement is a company has a 5% of net revenue agreement whereby they manage the center and get 5% of net revenues going forward. And from the fair market value perspective, we look at what services are provided, and we compare that to traditional management company agreements, look at what the market rates are for management services, and they might be 5%, they might be 7%, but 7% might include an administrator, for example, and then do a comparison between the two agreements to come up with a market value of the management agreement, management fee.
Okay. Blayne, any thoughts on that?
Well, if I was representing the buyer and that management company had a significant equity piece, then I would try to negotiate that to get that agreement out of their hands for a lot less than what they'd want to sell it for, because they're they have a big, they're going to take home a lot of money, take a lot of money off the table with their equity piece. So I mean, that's all I have to add. I mean, I'm not a valuation guy, but that's how I'd go about trying to get that out of their hands if I was purchasing and working for the buyer.
I guess how often, though, do you see management companies buying centers, or just any buyer buying a center that's already controlling interest owned by a management company? And I guess that's kind of my confusion with the question. So.
Yeah, I didn't hear the question where anyone was saying that it was what percent of interest. I was just using that as a scenario. If they had a significant piece, 30%, 25% is actually what was going through my mind.
Right.
All right. Go a little bit past the end time, take a couple more questions, and I want to give Curtis and Blayne an opportunity to share some final thoughts. Next question. What do you suggest if I'm already in negotiations with the local hospital to buy my center? They've already had the fair market value done, but I think it's not a fair price. What do I do? Blayne?
I've gotten that phone call a few times, and I personally, unless you're willing to go sell it to someone else, there's not a whole lot that I personally or someone in my role can help. But like we were referring to earlier, if you either have some offers or in hand that are higher than what the hospital came back to you as a fair market valuation, or you have a number in mind that you think is higher than that fair market valuation, I would tell you to challenge that fair market valuation. Go out and find someone like Kurtz that has significant amount of experience in the ASC space, pretty much seen and done it all. He's a lot older than I am. So he's pretty much seen and done it all in the space, and engage them to just evaluate the valuation and come back to you and tell you where the problems are, if any. They might come back and tell you, nope, that's a good valuation. That's the number that you're stuck with. Or they'll come back and say, hey, I see some holes in this, and give you some advice and kind of work with that person that has more experience to decide what route to go.
Curtis?
Yeah, to Blayne's point, we've gotten that same call, and kind of like you said, we'll review the valuation if that's the way it works. If you want to sell to that health system and you're working with that health system, so we'd like to get involved a little bit earlier get invited a little earlier to the party, where before the projections are done, we help you put input into the projections that are going to be used for the valuation. But assuming that the valuation's already done and you have a number, then question now is the health system willing to share that information with you? And if they are, we've ghostwritten letters on behalf of the ASCs because we don't want to be the ones out there arguing with another evaluator. I think there's professional courtesy. We'll agree to disagree with each other. But if the actual owners of the surgery center write a letter saying, these are the concerns we have with the projection that was used, or the discount rate that was used, or the tax rate that was used, or any of the inputs within the valuation, and they have a firm basis for that and support for it, which we give to our clients, then I think it's very helpful to our clients, and we've been able to increase the value as appropriate.
Excellent, thank you. Blayne, did you have anything else to add?
No, I think that was good.
Okay. Let's take our final question. Again, if we didn't get to your question, you submitted it. Make sure that your questions are passed along to our panelists. And again, definitely encourage you to contact Blayne or Kurtz directly. Their contact information is on this final slide. Any questions, feedback, or again, requests for future topics for upcoming webinars. Final question, and then again, I'm going to have Kurtz and Blayne give some last thoughts. Future earnings can increase dramatically if a currently privately held ASC is sold to a healthcare system that converts its reimbursement method to HOPD rates. This would potentially show disparate FMV. What about this factor in determining fair market value? Kurtz?
I'm sorry, can you repeat that?
Absolutely. If a privately held ASC is sold to a healthcare system that converts the ASC to an HOPD and thus receives HOPD rates, this would potentially show disparate FMV. What about this factor in determining fair market value? Can you factor in a hospital acquiring a privately held ASC and converting it to an HOPD and getting those higher reimbursement rates?
And I think that's the difference between the investment value and the fair market value. Investment value says a specific buyer, fair market value says hypothetical buyers. And we look out to the market of hypothetical buyers, and we can't pick one buyer. So the ability to get a higher Medicare reimbursement because it's now a hospital department, it's specific to the hospital, and we won't take that into account in the overall valuation of the entity. And that is something we can't take into account. There are ways to work with the hospital to continue to work with them on efficiency and operations of their surgery center through, we're getting involved in co-management agreements, for example, and different types of management agreements. But, ultimately that doesn't really affect our fair market value opinion. We just can't take into consideration. I know it's an issue. It comes up a lot. And I wish we could. I wish investment value was the rule and everybody could sell at investment value, but we're restricted to fair market value, which considers all buyers. So unfortunately, we can't consider it.
Blayne?
No, it does come up, and the way that Kurtz explained it is the way that it's been taught to me through the attorneys handling the deals and whatnot, and that's how I've explained it to the clients. So it's consistent with what I know.
Well, excellent. Again, that's all the time we're going to have for Q&A. Kurtz, I want to give you an opportunity to share some final thoughts, and then I'm going to have Blayne share some as well, and then I will conclude the program. Kurtz?
I appreciate everyone joining us today. Hopefully understand kind of the differences between investment value, fair market value, and how market value comes into play, and how that really affects the valuation process, and how the valuation process looks at EBITDA and normalizing EBITDA and using that and coming up with our ultimate value.
Excellent. Blayne?
Yeah, I echo what Kurtz said and appreciate you guys' time. I just would also want to add and encourage, if you have any interest in specific topics that Kurtz or I could help you with as far as a webinar topic or whatnot, then feel free to reach out to us, and we will work to make that happen.
Excellent. Well, thank you, Blayne. Certainly thank you, Kurtz, both of you taking the time to tackle a number of different topics, as well as several attendee questions. I certainly want to thank all the attendees for taking the time to join us today. This concludes today's program. I wish everyone a terrific afternoon and a wonderful weekend. Thank you.
Thanks, Rob.